Good morning, all. Doing a quick video before the market open. It is 7:41, and we're just going to do a quick review of the market, any changes that I've made to my portfolio, some different things that I think is going on in the market that's kind of pushing prices all around, and we'll just kind of examine from there. So here's the portfolio. Um, had a few things pay out, just different things like somewhere in here I'll show you. Yep, that's the IRA. Didn't do anything in the IRA. I had that small position in energy. I sold that. That was too tiny. I did have a dividend payout in Exxon. I sold that. That small Intel position that I had, the little one share I had, I sold all that. I sold some Walgreens because I was really up in it. That one tends to stay in a range. So I sold some of that, put it into QYLD just to increase my NASDAQ position. So basically what I'm doing right now is to increase my NASDAQ position because I don't trust this market, this position right here. Basically I'm buying an index, which is at QYLD. Um, and I'll explain what's going on with the market and kind of like when I might actually buy individual stock names in there. And when I buy individual stock names, it would be like Apple, Microsoft, that kind of stuff, maybe Salesforce. Um, and I'll just go over what I think is going on. So, just to give you a general idea why March seems so all over the place for the market right now. So, this is the portfolio right now. Um, I think since the last time I made a video, I'm probably up like 2 grand, I think. But, yeah, I'm up like 2 grand, I think. I think the last one I made a video called E-Trade's Busted that got a lot of views. I thought that was funny. E-Trade wasn't updating the prices correctly. That's the other video I made. So the last video I made, I was at 45,048. This was 1 week ago. So in 1 week, with no contribution, so there's no, this price isn't manipulated by me. I hate it when YouTubers do that and it doesn't explain like, oh hey, might count up $5,000, but they added $5,000. So my last video was 7 days ago. So that would be on the 5th, somewhere in here. Where yet? So there's no. I did actually. Sorry, I did make a minor deposit, 200 bucks. But I bought. What did I buy with that? I bought one share of General Dynamics. So, and then I took the extra amount plus I had what I had in cash balance, and I added that into like one share of Coke. So in 1 week, I'm up $1,800. So what caused that? Like, what is going on? So, like, why is this all of a sudden up $1,800? And I really haven't. I've moved minor positions, so like I gained some in AMC, but I didn't have a major position there anyways. So let's see what caused that. So what's effectively going on right now is you have a rotation. It's still occurring. It's occurring even as I speak. People are reducing positions, or they were, but they still are. It's going to happen again. They're reducing positions in the NASDAQ because these companies are driven more by low rates. Now, that's not every company in here. Some of these companies in the NASDAQ are just insanely profitable. A majority of them are actually just growth companies, which means they're still growing. So they haven't really posted too many profits yet, okay? So to justify that growth, they need low rates because they have to take on a lot of debt. So Netflix was like that. They were famous for it. They took on massive amounts of debt, but rates are low. The problem is if rates start doing this kind of stuff, a 6 basis point move in the 10 years is actually kind of a lot. So the 2 years not going to move really that much because this is what the Fed controls, Federal Reserve. Up in this area, I'm going to try and explain what's going on. So as that part of the market goes up, I've shown this in multiple videos before, somewhere in here. I talked about it a lot last year as the market was starting to kind of show some red flags. So these are the yields So investment grade corporate debt. Okay, triple B. This is where literally most of the market sits because U.S. companies are really, really badly capitalized. So whenever a lot of companies issue debt, AT&T, they all try to keep this triple B. The triple B is like the big thing. You go below triple B, you get in here, and you see how the rates like, if you want to issue 7-year debt, all of a sudden jumps an extra 3%. That's pretty major when you're issuing a debt in the billions. So what is going on? Okay, so the government bond rates, these bond rates right here, are going up. So everything below, so these right here are staying just the same. So you see how they're all really, really close to each other? Well, these are actually, so this is the corporates. So this little section right here, little section with the corporates, and you see the U.S. treasuries. So you see how there's a minor little difference, but this is double A. When you get into investment grade, and you get into that same little section, so you go down to the 1 year, see how it kind of gradually goes up. They're not showing B and double B and all that, but triple B. So because everybody issues in the triple B section because they're all just triple B, and they do this on purpose. So the rating agencies just rate these companies. So when these yields jump, so when these yields right here jump like this, it filters through to the entire market by, so this is the 10-year right now that's going up. And you see, this chart doesn't quite show it, but I have to kind of go back and forth between the two charts. So right now, see how it's 1.588, okay? For a 10-year yield, okay? As of this morning, that is 1.595. What happens is it filters through. So when you go down to the 10-year now, when it was 6 basis points less, you might as well just basically add 6 basis points onto this. And what does that mean? Well, now, and this is just an average, because if you actually click in here, I know a lot of people really don't understand the bond market, but when you go into the bond market, that percent that I just showed you is actually it's an average of this right here. So some of these companies that are considered triple B are issuing up at 6%. And you might be asking, well, what do they use this debt for? Well, some of these companies use this debt to pay their dividend. I don't think AT&T does that. I think they have enough profits to cover, or at least they say they don't. But to cover their daily operations, upgrades, that kind of stuff, they have to issue debt. So AT&T's in here. So the companies become very interest rate sensitive. You'll hear that word, interest rate sensitive. And what's going on is as the government bond sell-off above the 2-year, remember, because this is where the Fed is not supposed to control. They have ways of controlling it, and they're probably going to do it. But see how Disney's in here, Verizon's in here. And you see how they're issuing at this, like, so right now Verizon's at 2.3. Well, after today, this might be 2.9. Citigroup. These are banks, you're going to find a lot of U.S. companies in here issuing debt, and this updates a lot. Like, these guys issue debt all the time. These are all just separate, these are called debt offerings. Each one of these, see how it says 123, that's 123 separate companies issuing debt, and they're all competing with each other. So the real people that really rule the world are the ones that buy these debt. So what's kind of causing this right now? And why didn't you hear about this all last year? Well, what happened is, so there's a Bloomberg article, and sometimes they really nail it of what's going on, because they have really, I wouldn't say they're always bearish, but they do have some people over there that are all, they're always looking for a reason for the market to go down. So you have to kind of weigh what they're saying versus what's actually happening. Sometimes they get ahead of themselves. They're right, but for the wrong reason, kind of stuff. Like, they're right that there's a problem in the market, but it might not happen for another 6 months to a year. But this is an example of one that's actually really, really right. All right. So basically, last year, the Fed needed a way to control this part of the market. Because the real problem is when you go here. See this high yield part right here? All this high yield corporates, that collapsed. You, like companies were issuing debt right here, and the best way to track this is a stock called HYG. This thing right here. It's literally called the High Yield Corporate Bond ETF. This tanked. And when I say it tanked, I mean it tanked. It went down. So right now it's in, I forgot what it's worth. It should tell me what it's worth in here somewhere. But if this is a way that a lot of people get exposure, because it really does pay like a monthly dividend. It's really high, but it collapsed last year. Just utterly, just it when companies were issuing debt, nobody was basically buying the debt in the high yield corporate market. It's got $22 billion in assets. This is just one of them. It doesn't even include the amount of people that bet on the side if this thing's going to go up and down in the options market. So, and then this has just a portfolio of companies. I went over this, not the last video, but the video before that, where how to read these and what's included in here. So like T-Mobile's in here, Ford's in here, effectively junk debt companies, and it tells you what ratings all the companies are. So 11%, 2.5%, triple B, this kind of stuff. And what's going on is these funds that have this kind of debt right here. So if you remember during the mortgage crisis, if you ever watched The Big Short, basically they said stuff like if you see double B, it's actually probably a C or D or something like that, or I forgot. It's lower than that. That's not necessarily what's going on here, but what's going on is basically these types of funds that are everywhere tanked, just crashed, because all of a sudden those companies, and if you look on this on a year to date, let's go out 1 year. So this pays like 39 cents a share. It's an $86 thing, and normally this thing's been, turn off dividends so you can get a better idea. Whenever there's a rate scare, so whenever the Fed is starting to raise rates, this thing starts to tank. This was the last time it tanked. So December 1st, 2018 is when the Fed had that make or break moment, and this is when they were raising rates all through here, and it started to fall right about here, and then as the Fed kept raising rates, they kept raising rates, and then all of a sudden you got to here. Every time they raise rates, all of a sudden this thing tanks. And then look what happened to it right here. It went down to 67. Companies couldn't issue high yield debt. The debt markets effectively froze up. The same way that the mortgage market effectively froze up during the Great Crash or the financial crash, the debt markets froze up. That's a major, major problem. That's a really major problem. So the problem that's going on right now is the Fed decided to come up with these tools. So what they don't want to do is they prefer not to buy debt on the long end. They can suppress the 2 year by setting the rate, but somebody has to buy this. So all this debt that we issue, somebody has to buy it. This is long before that 1.9 trillion. You already had 1.9 trillion last year that was issued. You had another $900 billion in January. Now you have another 1.9 trillion on that. So these guys who like to call themselves the bond vigilantes were really big in the 80s. So this is why everybody's saying that inflation is going to take off, and this is what's causing this, and this is what's causing that. No, what's causing what's going on right now is this. This is about to expire. So the Fed came out with this thing. So there's a thing in Dodd-Frank that basically says banks can only take on so much debt. And you can only have so much leverage on an account. So to keep the banks from collapsing again, they basically have to keep a certain amount of money on hand to match the amount of debt that they're holding. Well, what the Federal Reserve basically said, so I'll read this to you. From April of last year, banks have been allowed to exclude treasuries and reserves when calculating their supplementary leverage ratio as part of the crisis measures introduced. This allows them to hold more treasuries than they otherwise would have done. So, what's going on? Handy dandy paint. Expand that out. Okay. This is beyond stupid, but all right. So you have a bank. Let's say they have to have. Okay, this is probably really horrible because I'm making it up right on the spot. Okay, so this is the debt that's in red. So what they said is you have to have that much green to balance out that much red. Okay. Now what's going on is if this red is made up, so like this red is made up of mortgages also because banks hold mortgages. But now let's say for example if this red was 100% made up of treasuries. Well, now all of a sudden the banks, where's your leverage? You have no more leverage. That kind of thing. So basically what they were saying is if instead of we'll buy the mortgages. So this is something that's really been going on in the background that a lot of people don't know what's driving this market higher. The Fed basically came out and said, okay, here's what we'll do. You buy the debt, we'll buy the mortgages. So you issue the mortgages. So the Fed has been issuing this thing, and if you read these guys on Twitter, they've been telling you this. The Fed they converted $80 billion, and you see the Fed's they have a little balance sheet that they issue, and it shows how much is on the Fed's balance sheet. And from like 1913 up until like 2009, the balance sheet kind of looked like that. And then all of a sudden in 2009, it went like that, okay? This is, and then I think the tech bubble was in here somewhere, okay? So let's just say this goes from 1913 all the way up till like 2009. And then all of a sudden, you kind of ride along here and it's kind of going like that. And then when you get to 2020, all of a sudden the Fed's balance sheet looks like that. What they did is basically they told the banks, okay, you guys keep issuing mortgages, okay? So we don't want the mortgage market to explode at the same time when the regular economy is exploding. You keep issuing mortgages. We'll buy those mortgages off of you. We'll take that mortgage debt off of you. But we need somebody to buy these treasuries because we're issuing a lot of debt. So the banks have been buying all the treasuries. Well, what's going on is you have all the guys who are like, okay, well, you have a lot of guys in the background that basically say, okay, if you're telling the banks that all of a sudden, so now here's what it probably looks closer like. I have a feeling this is what it really looks like right now. It probably looks something like this. And this is what's going on with the banks right now. And I can tell you right now, this is what's going on with the banks. Now you're telling the banks, okay, well, that little rule was temporary. So now, all of a sudden, because the rule still states you have to have enough of this to balance out your red. So now what's going on is, all of a sudden, this rule's about to expire. Well, the banks want to be compliant with the rules. So now what's going on is basically they're realizing that, hold on, if this rule expires, we're going to have all of this stuff on our books. That's all of a sudden we have to have cash to balance this out. So are the banks going to cut their interest rates? No. So are they going to cut their dividends? No. What they're going to do, or there's only two things that can happen. Either they issue less mortgages, so the mortgage market just goes to hell. They de-risk, which is exactly what they're doing right now. So they're getting rid of treasuries. This is exactly what they're doing, and Bloomberg has hit the nail on the head. I'll link this entire thing. It's not Bloomberg has a thing where you can read about you can read like 10 stories a month there, and they won't charge you. But every once in a while, they really do have a good article from one of their people that are down on the market where it actually does nail what's actually going on. So nobody's buying the debt. The Japanese aren't buying the debt because they have their own major issues because their economy's in the toilet. Their Federal Reserve is literally just buying the market right now. They're literally just buying like the S&P, SPY index for them. So they're literally boosting their markets and it's still failing. China's trying to do the same thing. Chinese markets are tanking. And the problem is this goes all around the world because all of a sudden this becomes very competitive, especially this and especially that, especially this right here, the big one is the 10-year. That becomes extremely competitive with something that's very negative in Europe. And there was one person that said basically our yields are, once you because when you go overseas, you get charged different. It's kind of weird how it works, but effectively, it's more positive now to own U.S. debt, and this is taking off like a rocket. Like this kind of move in a day is huge. Like this kind of stuff is what I saw back in March. Um, but it was going in the other direction. But now, so now what's going on is basically the banks are saying no, we're offloading our debt because the rules tell us we have to offload our debt to, we have to raise cash. We have to bring our cash level up to here, up to here now to match out all this that we own. So they have to, the Fed is going to have no choice. I promise you, there's no way. We have too much debt that's being issued right now. There's just nobody who can buy it. And the people that will buy it will tell you right now, the regular, these guys, you know, where's, these guys, the people that buy this stuff, SPY, NDX, Dow Jones, these guys down here, they will tell you, I'm not buying that debt until you can match, you know, until you can match the corporate rate. And you're getting 3-4% in dividend yields. They're just not competitive. So, like AbbVie's, like look at these dividend yields, 4.8. Caterpillar's 1.87, but look at that. That's starting to bounce up against the 10-year all of a sudden. So Caterpillar's going to have to raise their dividend. um, but they have to finance a lot of their cost with debt. Cisco, look at that, 3%, 2.76%, 2.45%. If these 10-year rates start bouncing up against some of those, if the 10-year starts bouncing up against that, which is entirely possible, if the Fed doesn't extend this rule, the market's going to go into chaos. I can tell you right now, if the Fed does not extend this rule right here, this March 31st thing, with this much debt being issued, with all the feel-good policies, it's just going to go into chaos. I can tell you right now that the NASDAQ will just bomb. And that's why I'm not touching it. Like, it will bomb. It would just straight up just tank. Um, so what you have to do is you have to watch this. Like, there's just certain things you just have to know in the market that's going on. And no YouTubers talking about this. No, I don't even think they know what they're talking about. They're just like buying randomly and they don't even know why they're buying. So, um, like Tesla is really exposed to this. Tesla is like really, really, really super exposed to this because they have just like a massive valuation. Um, I don't even think like their price to earnings is like Apple's is 25 and they're the most profitable company on the world. Like Tesla 1,125, which is why everybody looks at like Kathy Wood and when she says stuff like that, it's just like you're insane. Um, that's why it's like a lot of people have said like, okay, Tesla's had its run, but the only place it can go from here is down. And if you notice, as soon as the pre-market opened, down like a rock, and it's gonna go way way further. And what's driving it is this, and I'll link this article in the comment or in the description so that you can read it. But hopefully it gives you a good explanation of what's going on. What will I do with the stimulus money? Pretty much any company that has good profits, um, and that will ride this out. That's not exposed to rate pressures. Well, they're all exposed to rate pressures, but um, pretty much any company that's been able to maintain something like this through the pandemic. See this right here, 4.55%. That's going to be competitive no matter what. See something like that, they might need to raise this, which means this goes down. Um, any company that's been able to maintain their dividend throughout all of this, and also it's basically it's got to be somebody who has their dividend that's high enough and been able to maintain it. There's a lot of companies that would be forced to maintain like up their dividend, especially if the bond market starts to actually show some life to it. Um, the Fed's meeting is on March 17th, so either they're going to extend this rule. If they extend this rule, then rates are going to drop like a stone. I mean, it's just how this works. Because banks will like these will drop back down like a stone, but they would have to extend it another year because if they only extend it another 3 months, it takes that long just for banks to unwind this stuff from their balance sheets. Like it takes this long just for banks to get rid of this stuff. So they would have to extend it for another year. If they don't extend it for another year, you're just going to see chaos in the Nasdaq because this is the most rate sensitive area right here. Um, and you might be asking yourself, well, everybody's talking about inflation. It's not inflation. Oh, it's kind of inflation, but it's not the inflation that you're thinking of. It's manipulation by the Fed that's coming back to bite them in a very hard way. But nobody at the Fed has bothered to tell any of the politicians, look, guys, you kind of need to calm down with this stuff because we can only manipulate this for so long before we lose control of it. And the Fed does have a way of directly coming in here and buying this stuff. They do have a way of doing it, but then that turns into just utter and pure manipulation. They try to pretend like they're not manipulating it, but they're manipulating it. And the guys that tell you like, oh, well, it's because inflation, yada yada, the U.S. dollar's up, it's ridiculous. So they don't know what the hell they're talking about. Like Bitcoin's down, like it's kind of ridiculous. But what's going on is pure manipulation of the rates market by the Fed, and it's just a simple rule change. So, because somebody has to buy the debt. If foreign countries aren't buying the debt, then who's going to buy the debt? Because then they have to figure out a way to get somebody to buy the debt. So we'll find out on March 17th, see how it goes. But I'll put this link in there, and then just leave any comments if you have any questions. Thank you so much.